Your money-making broadcast starts now. Good evening. Today is June 8th, Monday. Here are the top stories moving to markets. We are witnessing a violent transition as the market enters its fourth day of a bear regime following the Warsh Fed shock. While futures show a slight bounce, the global landscape remains fragile with a massive tech sell-off and escalating geopolitical risks in the Middle East. In this session, we will analyze the structural shift in market regimes, the critical role of the upcoming CPI data, and how to navigate a high-volatility environment where traditional growth narratives are being dismantled. We will also examine the specific impact of the Warsh shock on semiconductor valuations and why a defensive posture is no longer optional but mandatory for capital preservation. We will dive deep into the Java's quantitative analysis to understand why the current price action suggests a deeper correction rather than a simple dip, and we will explore the systemic risks associated with the current energy price surge and its feedback loop with inflation. Before we dive into the big stories, let's look at the numbers from the market close. It was a brutal session. The S&P 500 index closed at 7,375, while the Nasdaq took a significant hit, and the Dow Jones Industrial Average struggled to find a floor. The Russell 2000 also felt the pressure as small caps are traditionally more sensitive to interest rate hikes. The VIX, our fear gauge, surged 34% to 21.51, signaling a clear entry into a high-fear regime. In other assets, gold is seeing some bid as a safe haven, but oil is the real story. Brent crude has spiked to $97.20, up 4.42%, driven by the reignited risk in the Strait of Hormuz. Bitcoin continues to trade with high volatility, reflecting the general risk-off sentiment dominating the current atmosphere. Our lead story today is the aftermath of the Friday crash, a day that will likely be remembered as the Warsh shock. The inauguration of the new Fed leadership has sent a clear signal of monetary tightening, sparking a mass exodus from high-growth tech stocks. To put the damage in perspective, the S&P 500 ETF, SPY, plummeted 2.58%, while the tech-heavy Nasdaq took a brutal 4.18% hit. The semiconductor sector was the epicenter of this collapse. Broadcom AVGO crashed by 7.92%, and AMD suffered a staggering 10.86% drop. Java's analysis confirms we have transitioned from a 42-day bull expansion into a bear regime, currently on its fourth day. The VIX surged 34% to 21.51 during the panic, confirming a fear-driven regime. From an investor's perspective, the Druckenmiller principle of maintaining high cash reserves, specifically 65% in this system, has proven to be the ultimate defense line. The core lesson here is that when the Fed pivots toward tightening, valuation multiples for AI and semiconductors contract instantly. We are not just seeing a dip, we are seeing a fundamental repricing of risk. The Java system currently has a negative edge guard applied to 18 major tickers, meaning the risk-to-reward ratio is currently unfavorable for aggressive buying. We are in a blocked state for most megacaps, suggesting that the bottom is not yet confirmed. Moving to our second big story, we look at the conflicting signals emerging from the global markets this weekend. While we saw a slight stabilization in the VIX, which drifted down from 21.51 to 19.86, a 7.67% decrease, the international picture is far more grim. In Asia, the Nikkei 225 plummeted 3.85%, and the Shanghai Composite dropped 1.7%. This suggests that the Warsh shock is not just a U.S. phenomenon but a global contagion of tightening fears. In the U.S. pre-market, we see a limited bounce attempt with S&P futures up 0.22% and Nasdaq futures up 0.56%, but Dow futures are lagging at minus 0.27%. This divergence tells us that while speculators are trying to buy the dip in tech, traditional industry players are still deeply concerned about the macroeconomic headwinds. The Java's regime assessment indicates that the sequence of the crash began with the Broadcom shock on June 3, followed by the official transition on June 4, and culminated in Friday's massacre. This pattern suggests a structured decline rather than a random flash crash, meaning investors should be wary of dead cat bounces before the next major catalyst. We must analyze the volume profiles. The selling on Friday was accompanied by massive institutional distribution, which typically precedes a prolonged period of volatility rather than a quick V-shaped recovery. Finally, let's dive into the macro landscape and the looming geopolitical threats. The most critical data point for this week is Wednesday's CPI report, which will act as the ultimate gatekeeper for market direction. If inflation remains sticky, the Fed's tightening narrative will be reinforced, potentially triggering another leg down. Simultaneously, we are seeing a dangerous escalation in the Middle East. Brent crude has surged to $97.20, a 4.42% increase, as risks surrounding the Strait of Hormuz are reignited. This creates a double whammy for the economy, tightening monetary policy from the Fed and a cost-push inflation shock from energy prices. When oil approaches the $100 mark, it puts immense pressure on consumer spending and corporate margins. From a sector perspective, we are seeing a flight to quality. While semiconductors are bleeding, the system is monitoring the medium risk levels of the Dow Jones Industrial Average and Berkshire Hathaway, suggesting that defensive, cash-rich conglomerates may be the only safe harbors in this storm. The interplay between the Warsh Fed's hawkish stance and the Hormuz risk creates a volatile environment where volatility is the only certainty. We are monitoring the 10-year Treasury yield closely, as any spike here will further compress the PE ratios of the remaining growth stocks. Let's talk about the portfolio action in more detail. Looking at our holdings, the semiconductor recovery was a bright spot. AMD surged 5.14% to $490.33, recovering much of Friday's 10.86% crash, while Broadcom climbed 2.82% back to $396.60, returning to its entry price. SoFi also showed strength at plus 2.93%, now at $16.50 and approaching its profit target of $16.74. But the news wasn't all positive. The software giant continued its decline to $420.20, now down 5.12% from its entry, and CRM fell further to $182.55, approaching its tightened stop loss at $178. This divergence tells us something important. The bounce is concentrated in the most oversold names while structurally challenged megacap tech keeps bleeding. The internal rotation suggests that investors are not returning to the market with conviction, but rather engaging in short-term tactical trades to cover losses. Wednesday's CPI report is the critical gatekeeper. Javas has analyzed 3 scenarios. First, if CPI prints 2.6% or below, that would be a major dovish surprise, likely pushing SPY back to $750 to $760 and opening a risk-on window. Second, an inline print of 2.7% to 2.9% would keep the market range-bound around $735 to $745, neither confirming nor denying the bear case. Third, and most concerning, a print of 3% or higher would accelerate the sell-off, with SPY potentially testing $720 or even $700. Our 65% cash position is designed to handle all 3 scenarios, and we wouldn't deploy capital aggressively until CPI resolves. This cautious approach is based on the historical observation that during regime shifts, the first bounce is often a trap for those eager to return to the market too early. We are essentially waiting for a volatility crush where the VIX stabilizes below 15 before considering new long positions. The VIX structure is also worth noting. It surged from 15.63 to 21.51 on Friday, a 34% spike that confirmed the regime shift from bull to bear. While the VIX has since settled to approximately 18.5 to 19.5, this level is still elevated enough to prevent algorithmic buying. I often say that bear market rallies are deceptive. The semi-bounce we saw today gave the appearance of recovery, but beneath the surface, megacap tech is still bleeding, bonds are weakening, and oil is threatening $100. The Paul Tudor Jones framework applies here perfectly. Listen to what the price action tells you, not what the headlines say. We must focus on the trend, not the noise, and the current trend is clearly bearish until a higher low is established on the daily chart. This requires a disciplined approach to stop losses and a refusal to average down into a falling knife. Looking at the oil market more closely, Brent crude surge to $97.20 is not just a geopolitical spike, it's a structural shift. The Strait of Hormuz risk has been simmering for weeks, and the combination of Iran tensions with OPEC Plus production discipline creates a genuine supply constraint. For energy investors, this means that any dip in oil prices is likely to be bought. The Soros reflexivity principle applies here. Higher oil feeds inflation expectations, which keeps the Fed hawkish, which strengthens the dollar, which makes oil cheaper for non-dollar buyers, but this damping effect won't fully materialize until oil reaches levels that meaningfully slow global demand, estimated around $110 to $120 per barrel. This creates a feedback loop that could keep inflation elevated even as the Fed tries to cool the economy. We are seeing a correlation shift where energy is no longer just a commodity play but a primary driver of macroeconomic instability. For our portfolio specifically, the Broadcom position at 25.4% weight is the single largest concentration risk. The stock recovered to its entry price of $396.60, creating an opportunity to trim. The Druckenmiller principle demands we protect capital first. If Broadcom breaks $380, we should sell at least half that position. Similarly, megacap tech continues to be a point of concern. The AI competition narrative is real. Open-source models are eroding the perceived moat of the giants. If it hits $410, the remaining position should be liquidated. And CRM at $182.55 is just $12 away from its $170 stop loss. Enterprise software rotation is a structural trend, not a temporary dip. We are prioritizing liquidity and risk management over the hope of a quick recovery. The goal is not to maximize gains in a bear market, but to minimize losses so that we have the ammunition to buy the eventual bottom. To recap today's themes, we are officially in a bear regime with a high volatility environment driven by the Warsh Fed's tightening signal and geopolitical instability in the Middle East. The strategy now is extreme caution, prioritizing capital preservation over aggressive growth until the CPI data provides a clearer roadmap. We must remain vigilant and avoid the temptation to overleverage during short-term bounces. The combination of a hawkish Fed and rising energy costs is a classic recipe for a stagflationary environment, which requires a complete rethink of traditional 60-40 portfolios. For our stock recommendations, please note that Javas has applied a negative edge guard, so these are risk-aware watchlist picks rather than aggressive buy signals. First, the father of modern value investing Benjamin Graham would choose Coca-Cola, KO, at $62.15. In a bear market, Graham prioritizes safety margins and consistent dividends. With the current volatility, a low-beta consumer staple provides the necessary hedge against a broader market collapse. This is a play on stability and cash flow reliability. Second, the legendary Wall Street fund manager Peter Lynch would look at SoFi Technologies, SoFi, at $16.03. This is our balance-type pick. He focuses on companies with strong growth potential that are still reasonably priced. Despite the bear regime, SoFi's ability to capture a younger demographic of financial users provides a long-term growth trajectory that balances the portfolio. Third, the world's leading innovative fund manager Cathie Wood would target Palantir, PLTR, at $24.50. As a growth-type pick, she would see the current dip as an opportunity to accumulate a leader in AI software. While the semiconductor hardware is crashing, the software layer of AI remains a long-term structural winner with high scalability. Finally, the master of global investing John Templeton would consider Rio Tinto, RIO, at $65.20. This is our low-cost, contrarian pick. He specializes in identifying undervalued assets globally. With the current volatility in tech, shifting focus to diversified miners with strong balance sheets offers a strategic hedge against inflation and a play on the eventual recovery of global infrastructure. Subscribe to stay ahead of the markets every single day. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.